And we are live. Hello and welcome, everyone. Today, I have Dirk Sahlmer with me. So, first of all, Dirk, on LinkedIn, we already announced that you're super funny and you're king of memes. So, no pressure on that. But on the professional front, Dirk is a head of origination at SaaS Group. Dirk, maybe before we move on into the content, why don't you tell a couple of words to our audience about yourself?
Yes. So, hello everyone. And you already set the bar pretty high with the fun stuff. So, I mean, this is more about knowledge sharing, I guess. But I might be able to drop some funny lines. Yeah, my name is Dirk. I'm head of origination at SaaS Group. SaaS Group is a serial acquirer of small SaaS companies. Since I joined more than 5 years ago, we acquired roughly 20 companies. We are specialized in small bootstrap or capital efficient PLG SaaS companies. And so my role includes talking to SaaS founders about exits all the time, structuring deals, reviewing KPIs, and so on. So I've seen a lot of things that went wrong, things that went right, what the typical questions are about the exit process, pitfalls that founders can avoid. And so since I had to learn SaaS from scratch as well, because my background is mechanical engineering, I'm happy to share that stuff that I had to learn myself also with others and give tips and guidance on how to go about exit process and so on.
So this is going to be our main discussion topic for today. While the audience is still coming together on LinkedIn, we have this tradition, and I can already say that this is a tradition in our webinars, because it's more than free, which makes it already a benchmark. The intro question, or the warm-up question about the future of SaaS startup, actually the future of SaaS, but not a year from today, but 10 years for today. So, it's about the imagination, a bit of visionary, but how would you describe SaaS world in 10 years from today?
Yeah, I would say it started to change quicker than before. But I think I would also take everything you see online with a grain of salt. I mean, all of a sudden it seems like you can build Calendly, DocuSigns, and so on just by vibe coding over a weekend. I think we're not there yet. And I mean, in our small tech bubble, yes, we see like technological advancements. We are basically the first ones to see it. And everyone now thinks, okay, SaaS is in danger. And in a year from now, everything will run by agents. I think the transition of like the broader population and the market and the client base will take much longer than we think. And recently I saw a slide, and I think I also shared it on LinkedIn, about Thoma Bravo. It's a well-known software PE firm, one of the biggest ones and well-known ones. And they shared a slide that the majority of software revenue still comes from on-premise solutions, and especially in traditional industries, a lot of is still on-premise, and SaaS is basically just a fraction because many companies haven't even moved to the cloud. And so, yes, AI will be a topic, and yes, I would encourage everyone to work with it and see how we can integrate it into your day-to-day, like make things more efficient, and also maybe in your product if it provides value. To answer your question, I think it will develop. We will see more AI solutions. We will see more efficient companies. Maybe companies may be able to spend the money they save on something else, because people that are skilled in AI will become more expensive. But I think because everyone is preaching like death of SaaS, I think it's not happening in the next 10 years or even 20 years.
I actually, I second your opinion, and especially about the on-premise data that you shared, or you were referring to, because me working also in the software business, helping our clients with pricing, I have so many discussions with, agriculture technology, chemicals technology. Some, we just concluded a project like 4 or 5 months ago. There was a SaaS software company that was responsible for identifying if there is a breach in the pipe right? So there are like
Mhm.
pipes in the ground, and sometimes they are getting sometimes they are broken, right? And
Mhm.
those industries are typically very traditional, and most of the solutions that I was like most of the founders that I had the discussions with, they're still like, yeah, but like most of our clients are still on premise, right? And I was like, okay, so there is not that much information on that on LinkedIn. I thought like everyone is already in AI, while the reality is much different than our software bubble. So let's try to focus about nowadays, about like today, year from today, and let's try to talk about a bit about the exit. So a very generic question at the very beginning, but do you think that in general, from the macro perspective, economic perspective, is it a good time to exit in general? Because I have the feeling that for some of my clients, some of my friends in the industry, like they missed the point. It was like 2-3 years ago, the multipliers were super super high, and right now it's a bit more challenging. It's a very small sample, it's my close group, but from the macro perspective, what do you think about it? Is it a good time generally?
I mean, nowadays you can ask me probably next week, and I will give you a different answer than this week. It can change quickly, as you may have seen. I would say if you have a decent business, and I mean that's not macro, that's also a generic answer, but it's the right time to sell if you think it's the right time to sell, because it's with any other asset. Like selling at the top is difficult. Selling when the market is at the top is difficult. Selling when your business is at its peak is difficult. So it's just easy to miss that point and to sell too late or maybe too early. You never know. I mean, some companies exited and then they rose to completely different levels, and other ones that tanked afterwards. So there's not a right answer. I would generally, like, just from what I'm seeing, I think the broader market sees that it's a good time, because I'm seeing much more deal flow recently, especially at the beginning of this year. We saw a big increase in inbound deal flow from M&A brokers. So I think they all wanted to wait for US elections and how everything develops afterwards, and not start before. And many were still, let's say, fixing some issues in their business last year. And now I think people became more open to it. And from pure market numbers, I think multiples, if you look at the software or SaaS M&A multiples, they have been pretty much flatlining for the last 1.5, 2 years. I mean, there's median numbers. If you look at, I think Software Equity Group publishes a report on a quarterly basis. The median is like 4, 4.1, 4.2, 4. So there's not much movement. And so just a few cases can maybe like pull it up or bring it down a bit. So I would say, generally speaking, the market is quite stable at the moment.
Crystal clear. So would you say to the founders that at the level current, like our bubble that we are speaking, so those are not gigantic companies, like still decent companies, but they're not that much influenced by the macro factors, and you should rather focus on your micro factors, internal factors, while deciding on selling? Do I read it do I read you correctly?
Yes, correctly. I think like just also from the conversations I'm having on a daily basis, there are many founders that actually, like, the point where they actively thought about an exit was like 2 years ago, but they still think it's not the right time, and so they are just trying to chase that carrot to maybe get to a point where they might be able to, like, you never know, but might be able to sell for a slightly better price. And then the questions you need to ask yourself is like, is it worth waiting? And there's still no one gives you certainty that it will be worse tomorrow or better tomorrow. And so, like, do you want to have certainty today and you're able to take that maybe small discount for certainty, or do you want to see how the future looks like and keep the business for now? So it's more about your own thoughts, about reflecting, about thinking, hey, can I bring this further? Can I get a higher multiple? Is it significantly higher? Could I put that money to work elsewhere right now and maybe get a higher return? What's important for me in life? Is it the time I get by selling? Do I enjoy the ride still and want to keep it? So it's maybe even like a philosophical questions and more like the macro factors and how you think about the journey of the company, the current status of the company, how far you can bring it, your own abilities, your goals in life. And this should
Rarely,
ultimately define when you exit.
rarely the price, right? But then, so if you enjoyed the ride, I can get that this is a philosophical questions. And when I was like talking to founders, before exit and after the exit, we were rarely talking when those, I had the feeling that they're actually ready. Rarely we were talking about the multiples at the price. We were rather talking, maybe because money, like to be silent, etc., etc. But we were rather talking,
Yeah.
okay, I'm already tired, right? Or I have the feeling that I don't bring as much value as possible. I also know founders that are like, I love my company, but I love building. And right now it's much more about building processes than products, right? So it's a bit boring, right? So from your perspective, then what would be the right time to start thinking about exit? Like from, the conversations that you are having, is there a right time?
Yeah. So I would say maybe back to the philosophical question. I think the happiest founders I've met, they know that they can bring it thus far and that's it. And they are happy like building and they're still involved in coding and they like it and they enjoy it. And they don't feel comfortable leading like a big team and building like multiple management layers, building an organization, implementing processes, and make this like 100 million ARR company. And so the people that reflect and they come to the conclusion, okay, I can bring it so far, but then I need to hand it over and I may start over again at zero. Like they are happy because they know, okay, this is my comfort zone. This is what I enjoy. And there are many that try to go beyond. And I mean, that even affect every individual in their role within maybe a startup or a company. Like, am I the individual contributor? Am I the manager? Am I like a C-level? And sometimes it's the first time you find out, but I mean, you're probably going through a phase where you think like, okay, I'm not happy with this one. I don't know, can I bring this further? And so if you have this gut feeling, there's something not right, or I don't fully enjoy it, but I also can't let go. I think that's a good point to at least start conversations and see what's out there, and see if you could get help, partner up with someone, or maybe even sell the business. And from a traction perspective, I mean, usually you have that early phase, you find product market fit, you're trying to figure it out, then it takes off. Sometimes it grows a bit faster now with AI solutions, maybe sometimes more sustainable, maybe with a lower growth rate. But there's this S curve, right? It starts slow, then it goes up, and then at some point you may struggle to keep the growth rate, and it starts to not flatten out, but at least there's a growth decay. And so ideally you sell along this line. But again, if everything is going well, you might not consider a sale because everything is going well. So you might miss that point.
So today I read the post by one of the quite famous Polish business angels, Tomek Karwatka, and he was saying that if it's going right and if you're in the upward trajectory, at least consider selling parts of your business, just to pay your mortgage, just to have a safe harbor, or a parachute, right? So you don't have to sell it all, but you can sell like part of the company when there is an upward trajectory. And here I would like to ask you a question, because exit, like participating in different conferences, I have seen that there are different colors to exit, right? You can sell the company, that's number one, but you can actually exit operationally and be only at the board of directors, executive board, or something like that, not operationally participating in the company. You can move into from CEO to CPO and partially exit, so sell partially, hire the CEO and be responsible for that one direction. How do you perceive these different flavors of exit? Do you see that that one is better than the other, or like what founders were the most happy from your perspective?
It's also something I keep saying to founders is like, if you come to me, best case scenario is you know what you want and you really thought about it. I mean, I'm happy to give some guidance if you don't know what you want, and I can tell you what our offering is, and you can compare it to others. That's fine to me. But if you are actively seeking an exit or whatever, I think it's good if you did some research already and okay, I want to exit, I want to sell it, I want to stay maybe for half a year, maybe a year, not longer, and then I want to do something else or take a break or whatever. And also about the financial part, like, do I want to get partial liquidity? Do I want to sell everything, optimize for cash upfront? Do I still see some upside in the business? Would I accept maybe an earnout? How ambitious can that earnout be? Can I execute on this? Do I see myself becoming part of a bigger group? And then you have multiple exit options, as you said. I think generally speaking, I mean, unless you're on the VC track anyway, I think giving away equity, you should be super careful about it. Like generally speaking, so saying selling along the way and get some liquidity by selling some shares to your uncle that you've never met or some random folk that would be interested in getting a shareholder. I think that will fall on your feet once you pursue a full exit, because then you just have like too many stakeholders. They all have different expectations. They all have different interests, and it's hard to get them on a table at the table and agree to certain terms. Just experience firsthand.
And maybe a controversial question, I hope not here, but you were saying about the different options. Are there any, orange or red lights when, for example, founders optimize for, I don't know, the cash up front or something like that? Is there like, something that you see that, oh my God, there must be something in the, like, I know there is a due diligence process, etc. I was also participating in the due diligence process. There were professionals who were hired, and there were some things that came afterwards, right? So I mean, due diligence, of course, always should be there. Nevertheless, I mean, there is certain risk. So is there anything in between the lines that founders should be aware that, hey, if I'm optimizing a cash up front, most likely, well, there must be something wrong with this company?
Not necessarily, if they can provide proper arguments for it. I think every structure is valid if you can argue for it. It's more from like a buy side, what founders should be aware of, which like I would personally not do if I would sell my business, is like accept a large seller financing, for example, where you basically don't get a lot of cash up front and the buyer basically pays it over time or a few years after they acquired the business through dividends or cash flows that the business produces. Basically, if the business defaults and if you don't have full confidence that they can run it and grow it, then there's a high risk you will never see that money. What's also at least high risk is if you convert your shares into the acquirer's shares, unless you think they are the winner and they will succeed in the long run, because like your exit return is basically tied to their performance directly. And so I've seen good and bad cases where people basically sold their really cool big business for a few $100,000 because they opted for a high share swap or a high seller financing component, and the business defaulted or at least tanked. So not something recommendable. From a founder's side, like what I personally see as like a red flag or at least orange yellow flag is if a founder is not honest in the first conversation. If they're like, if it feels like they are hiding something or they're just not telling everything, it just gives a negative feeling. And in the due diligence process, you should be prepared that buyers want to see everything, like every paper from incorporation certificate to every document that has been created since then. every shareholder meeting notes you have, everything, your billing data, list of your customers, any disputes you had, your employment contracts, employees that quit, why did they quit, how is your employee turnover, like just like everything. And so if you try to be super hesitant with sharing important information up front, it's not a good sign, to be honest. And that just makes us dig deeper at the end of the day, because we know, okay, there must be something.
So then, how would founders like prepare themselves the process? So let's assume that I already made my mind. I want to investigate my options. By the way, there is a side question to it. Does it make sense to investigate your options like every 6 months? So like I remember when I was working on the contract, I was looking at LinkedIn and offers like every 6 months to see if my salary is in the right place, etc. Like, does it work also in acquire business like this? And I will come back to the question. Sorry for the side note.
Yeah, it's a good question, and generally I would say you should prepare pretty early, like even if an exit is not relevant at all for you, because sometimes great opportunities pop up at the random point in time and you're not prepared and you might lose out. Let's give like a maybe weird example, but let's say Microsoft corporate development team calls you tomorrow and tells you, hey, we're looking to buy one company in your particular segment and we mapped out the market and these are the 5 targets. Can you send us some stuff? And you're like, I need to prepare and like give me 4 weeks. And another one is faster, they might just buy the other one and then the opportunity is gone and they might never come back again and buy a company in your segment. So it can happen quite quickly, but I think from my experience, it takes quite some time to build a relationship with the acquirer, to stay on the radar at the acquirer, and to build some trust, and to also think that this is the right option. So I actually encourage every founder to take calls with buyers quite early to see what questions do they ask, what stuff are they requesting, what do I need to have prepared, what's their model, does it suit my strategy, could it be an option, just to already have some basic knowledge about exiting and buyer profiles and so on when it becomes imminent. Because I think the biggest mistake I see is that founders are like, okay, now the time has come, now I might start to talk to buyers, and then it still might take 1, 2, 3 years for you to close a deal. So it's a long process.
Good practice also, to have your eyes open. That's number one. And then like if you decide to sell, like your first conversation most likely shouldn't be the one that you proceed with, right? You need to make some mistakes. And that is what I have seen. We'll go to the question how to prepare yourself, but then maybe before, let's take the question from Rishi from the chat. So there is a question, Dirk, it is for you for sure. What are the typical exit multiples you're seeing in the current market? What is the North Star metric being used for SaaS companies, ARR, EBITDA, or revenue?
Yeah, so very good question, and a standard question founders ask me. First of all, it depends on the size of your business. So we can look at the public multiples from public SaaS companies. They tend to be much higher because it's just massive companies, massive revenue, great scale. And so they are just trading at slightly higher multiples than the private market. Then if we look at the private market, the problem is the data you will find is mostly like the whole private market, and that includes transactions that are happening at like 3-5 billion, and it includes transactions that are tracked that might be happening at 100 million, but they rarely track acquisitions in the what I would call like micro cap space. So let's say companies under 10 million, unless they get bought by like Salesforce, Microsoft, which appears in the headlines, and so they tend to be valued even lower than, let's say, the private market. And so most of those smaller transactions are happening somewhere between, let's say, 1 to 4x revenue multiples. And you can look it up. I mean, I'm not making those numbers up. You have like M&A platforms like acquire.com, flipper.com. They are at least showing certain data on that microcap market. And what you also need to be aware of, that the further you go down in terms of ARR ranges, the less interesting it is for strategic acquirers, because as a 2 million ARR business, you cannot have like a significant moat or a super strong IP that a strategic might be interested in, or access to customers they don't have access to. And so a lot of buyers in that segment are financial buyers, and they want to ultimately generate a positive return on that acquisition. That means they will always look at your fundamentals, your profit margins, your growth, your KPIs, how good is your retention, etc., and less so about, oh, cool, he or she closed that big customer or whatever. So IP, customer list, and so on is maybe less relevant, and fundamentals are important. Top valuation factors, I think revenue growth is still number one. But it also depends on the buyer profile. But generally speaking, revenue growth number one, and also more generally speaking, capital efficiency. Like all of those buyers, including SaaS Group, including us, we are looking for capital efficient business. We don't want to have companies with bloated teams, overstaffed, capital inefficient, investing too much into marketing, low or no ROI. And then we're looking at LTV to CAC, at CAC ratio, CAC payback, rule of 40, EBITDA margin, ARR per FTE, all those efficiency metrics to see like how do you perform. And so if you say, okay, growth is the number one valuation factor, but we struggle to grow significantly, you can still get a pretty decent outcome by just being capital efficient and have a decent profit margin.
Is capital efficiency, I know it's not a new term, but I remember when I was moving from like big consultancy to the market that I'm currently in, I don't remember this term being used quite oftenly, neither profit, it was rather on growth. Right now I see it used more often. Is it a trend, or I just missed something a couple of years ago?
I would say it became more of a trend with after the SERP period, like 2020, 2021, after COVID, and that big boom and the numbers came down, and everyone was saying, everyone needs to become more capital efficient, because just the cost of capital increased. And so generally it means, to give you a concrete example, let's say a company with 2 million ARR, they're not growing and they are break even. Like, what's even the point of having such a business? Like, either it generates cash flows or it grows and it starts to generate cash flows in the future, but it does neither grow nor generate any profit. Like, I know it's maybe like a weird example, and I don't want to say that this business doesn't make sense, but you need to make a decision. Like, do you want to grow this into a big company? Because the valuation will be based on your business ability to provide a positive ROI and to generate cash flows. And cash flows could also include a future exit. So let's say you have a 2 million company, someone acquires it, holds it for 5 years, grows it to 10, sells it for a 5x multiple, then this is also a cash flow that comes in. But if you have a 2 million business, it's not growing, and I hold it for 5 years, I can neither generate any cash flows through profits, nor can I generate cash flows by value increase. So it's not super attractive for a buyer unless they see something you haven't seen and they can all of a sudden triple the business and make it profitable. So it's a much higher execution risk, and buyers might factor that in.
I think, from, where the discussion is heading, I mean, you can also read macro trends. I also remember post-COVID, CAC to LTV became CAC payback period. Like, I know it didn't became, but then, I was hearing this term more and more often during the conferences, also from the investors. So you can also see the macro trends. By the way, they support my profession, which is pricing. Nevertheless, this is not the topic for today, but I will make the play there as well. So let's come back to the initial question. Thank you, Rishi, for the question. Cornelis will ask your question in a minute, but let's finish the first that I was trying to ask. So how to prepare your company for the acquisition, how to actually do it, how to start the process, and what is the, I don't know, how do you say this, lists, like there's a word to it, but like, the checklist, is there a checklist for the preparation?
Yeah, so one topic we already covered. So just try to get in touch with potential buyers you see as relevant exit channels, and try to get in touch with the corporate development team, with the M&A team. Just have a chat. I mean, just 30 minutes. I know everyone is super busy and so on, and you do not need to do it.
For a second, because
Yeah.
just to understand, just to get in touch, but like super operationally, because I have seen this happen when, okay, but how, right? Do I go on website and I write to you, or do I go on LinkedIn? Like how, very operationally get in touch. So how to, like, what is the best way to, I don't know, reach out to you for example?
Yeah, I mean, I would say SaaS Group itself makes it quite easy. You can use our website form. You can drop any of our employees on LinkedIn a message. You can send us an email, or you can use the sales enablement tools you're using anyway to look up our email addresses online. You may also find them. And then you can just, it will find its way to our team, and someone will get in touch for sure. Other buyers as well. And I think a good point would be like, who acquired businesses in your segment before? Who do you think is relevant in your business? So if it's like a 20 million ARR business, then strategic might be interesting. If it's a 500K ARR business, then might be more financially oriented buyers or serial acquirers like us might be interested. And I mean, what could they say? Yes or no, right? So just try to find the email. If you have an M&A person you find online, just try to get in touch with them, send them a connection request, say you're looking to exit at some point, and just try to connect with potential buyers. Boom. It's that easy. It's like you do some research within your ICP to build your target list and maybe do email marketing. Nothing else. And then just have those conversations. Also, if they come inbound, over time, if you run the business for a couple of years, you might get inbound messages from buyers from now, and then just collect them somewhere, like flag them as buyer message, so you can like pull them out at some point when it becomes relevant and warm them up.
It's always good to reply, right? Because then you write to the investor, and then it turns out that he or she wrote to you 3 years ago, and you have never say neither hi nor thank you, right? So,
and I think it's common sense, but just be polite. I know everyone gets spam, like email marketing stuff, pitches all the time, but if it's like a buyer, like never say like fuck off, or I would sell for a 50x multiplier, because what's happening, and I can just talk from my own experience, I will take a note in the CRM, like this founder is hard to deal with, or got offended quite quickly and stuff like that, or had super steep expectations. That's something that pops up in the CRM and it stays there. And the next one to follow up will read this and maybe just say, okay, it's not worth following up. So he will just disappear from their target list maybe. So just be polite, tell them what is, maybe even share some high level numbers if you feel comfortable. And that's it. And you can still say no. They will accept the no. They might follow up if they continue to be interested. And then when it becomes more like concrete and you really want to seek an exit, take those conversations again, like warm them up. And just like you would sell your house, basically just bring that stuff in order. So you wouldn't sell your house with like stuff still laying around and maybe some food in the fridge and weird stuff, and like dirty walls and whatnot. So you would try to clean it up.
You are not selling a house in Berlin, right? Or renting a house in Berlin.
Well, in some locations, the demand is so high that you might be able to sell this as well. but just try to make a good impression. So it's very generic, but that means, for example, to your code base, is it well documented? Can somebody else work with it? Do they understand it quickly? Do you have your numbers in order? Do you have like a standard SaaS income statement, or are your numbers a mess? Because that's the first thing buyers ask for. Do you have everything in folders? Do you have scanned documents? Like just bring everything in order. Are there clear processes? Are there clear reporting lines? Who's doing what? What are the responsibilities? Do you have like employment contracts stored somewhere? Because first of all, there's the same time kills deals. So the longer you take to find that stuff and deliver it, it might delay the process, and buyers might focus on another target. And generally speaking, it just makes a bad impression. So
and from the financial or like business standpoint, because like let me tell you, let me bring a bit of a context here. So when starting a value ships together with Maciek, I thought that our typical clients will be companies like pre-exit or the private equity funds who are selling their business. Why it's that? Because with pricing, typically you have 10 to 15% of your revenue leaking in the discounting. On the, like, there are multiple studies behind this. I have seen it like in every customer, PLG, SLG, grandfather, there's always 10 to 15% of the business leaking, revenue leaking. And I'm like, okay, you just seal this business and then your revenue goes up by 5, 7, 8%. If you're lucky, you'll make it 99% success rate. So it's going to be 15%, right? So, and I was super, super surprised not to see, the avalanche of clients reaching out for my support with like, discount management. Reality hits hard, but down the way, I have more and more clients like this. So is there, and for me, I'm not talking about like very big pricing exercise just to boost your revenue. I'm just saying about very simple thing. I mean, you have 10% revenue leaking in your discounting, close it, you'll earn more money. Simple as that.
Yeah.
Is there, like, do you agree? I hope. Number one, and number two, is there anything else business-wise that you would recommend founders to consider pricing-wise more frequently? For me, it was PE reaching out to me to look if there is a pricing potential after the acquisition. So that's even more funny, right? But business-wise, is there anything? Is pricing one of them, and is there anything else that you would recommend founders?
Yeah, definitely. I mean, pricing could be an opportunity for a buyer if you haven't increased your prices in the last few years. So rather than optimizing your business on short notice because it goes towards an exit, I would start to develop that muscle early on and maybe tweak it every now and then and try to play around with packaging and pricing just to learn and to not miss out. I mean, there are studies, I think there are paddle reports and whatnot that prove that if you work on it regularly, even if you mess it up, you just experiment, you learn, you iterate, you become better at it. You tend to grow faster or have better retention metrics after all. And so don't start doing weird stuff in the year or the 2 years before because you want to prepare the business for an exit and try to bring it in a better shape. I've seen the worst things. And the thing is, sometimes we dig much deeper than the founder ever went. And so we see those things if you messed up your pricing, how good it went, how your cohorts look like, if you gave pretty high discounts all of a sudden, if you try to raise prices twice in a year and messed it up. Like you see everything. You can see it if you look at the cohort data, how your churn of your Black Friday campaigns is much higher, how you try to broaden your marketing campaigns and acquire customers that are non-ICP have a higher tendency to churn. So all of those things that might bring some growth in the short term is something we see. We see how you reach that point, and we will factor in as a risk, as a discount, or might even walk away because we think, okay, like we can't help that much with the business. And so pricing, definitely a topic you should tackle, not shortly before an exit. And that applies to a lot of things. And to make a last point, what would also be obvious is you basically in the year before exit, you sell monthly plans or yearly plans or even usage-based revenue. And in the year before exit, you give heavy discounts and try to transfer everyone on multi-year plans, like obvious, right? And then all of a sudden you have a strong cash inflow. Everyone pays up front for 2 or 3 year contracts, and you're discounting them heavily with like 40% or so. And then all of a sudden your revenue goes from like 2 million all of a sudden to 5. And you go to a buyer and says like, look, our impressive growth, and we were able to accelerate it and everything is great. And we look at that stuff and it's like, okay, we see what you did there. We're not going to touch this business. So always try to be careful with short-term experiments.
It is like, I have the feeling that all of the things that in technology, they were already present somewhere else, right? It's like with a car, right? If you see like beautiful Porsche 911, and that is like, instead of 200k euros, like 80k euros, there must be something wrong with this Porsche, right? If you see the market of, I don't know, HR tech growing on the yearly basis on average 20%, and you have this one player that is like suddenly was growing always 20%, and then suddenly it's 300. Well, maybe lucky, of course, it can happen, but rarely happens. Rarely this is an outlier. It's just a trick. So the tricks are not longer valid, I guess. And also, I guess, correct me if I'm wrong, but like business matured, but also acquirers matured. Maybe those things could happen like 10, 15 years, 5 years ago. But right now, I think that there's so much knowledge on the market, and like acquirers like are so professional that you can't really hide those things, right?
Yeah, and I mean, back to the point with pricing. I mean, you could say, okay, damn, I haven't raised the prices in 5 years. Now I'm seeking an exit. I mean, maybe that's one project to still execute before I talk to buyers. Valid point, and you might be able to do it. Then that's not an opportunity a buyer could pull off, but you could still do it. But then at least do it properly, because very often founders or companies are doing it to optimize for an exit, or because they saw, oh, okay, that's like a lost opportunity, and then it's just badly managed and badly communicated. And then we would look at the business and like, okay, for now, the opportunity to raise prices again is gone, but you messed up the previous one. And so you basically lost twice. So, but I mean, like, people should just reach out to you. I'm not a pricing expert, but just saying like, you need to orchestrate it. Like customer support, customer success needs to be educated. Okay, what's the communication strategy? What email do I send? How do I deal with objections? Can I offer some discounts? What kind of discounts? So it's a strategic project. It's not, okay, from tomorrow on, we will just charge twice the price.
So okay, so let's imagine that, so down the line, right? You've been talking to some buyers as a founder, so you're a bit experienced. Your house is clean. You have everything in order. You you documented the things that were not documented. You have pretty BI graphs, blah blah blah, stuff like this. So then to the Cornelis point, then should you then involve a broker in the transaction, or you directly talk to the buyer?
A good question. I mean, it depends, and you can decide yourself. There are pros and cons for both sides. If you do it directly, I mean, I'm a buyer, so this is something I would not prefer myself as a buyer. But as a founder, I would encourage you to talk to more than one buyer. So you're not completely dependent on them putting an offer or walking away. And you have optionality, and you can compare, and you bring in kind of a competitiveness. Because it always helps to create some FOMO if someone really wants to buy you, and it might get you a slightly or even significantly higher offer. If you think this is like everything is this distraction for you, and you need to take care of day to day, and you want someone who has market knowledge, who knows the market value of business, what they could get, and they should have like the first conversations and map out the market of potential buyers and see what's possible, and just collect those initial offers. Then hire a broker. They might charge a certain amount. It's not cheap. It's also not for every business, because brokers are also super selective. So if they think I will have a hard time finding the right buyer for this, or I will have a hard time finding a good offer for this, then they might just reject you. So they're also super selective, and some founders might struggle to get a buyer and a broker. And if they get a broker, it's sometimes black sheep in the market, and you create more damage than you win something, because they might take broker mandates in different industries, so they're not fully familiar with SaaS, or they don't have a proper track record and just want to make a quick dollar. So you should be super careful and do some reference checks for brokers. Could be totally worth it. Depending on the business size, it might cost you a couple $100K, but it might get you a better offer. On the other hand, if you think, hey, it clicked with the buyer, everything fits, the offer sounds fair, they can offer the structure that I want, everything fits, like, why introducing a broker? There's no clear benefit. So if you're happy, you're happy, then take it. If you think you want to have someone take care of it and you are willing to pay a price for it, then go for a broker.
But I think that second thoughts here are are not the best guidance, right? If you're happy, then you're happy. I mean, if they say yes, most likely you shouldn't say, oh, maybe 10% more, or maybe we'll change disclosure, etc. This is I've seen this in practice, that of course it creates a lot of friction, and sometimes it's like counterproductive results with some last minute negotiations, etc. So I think that here we are on the same page, and so then, like, going to the next question. So we were talking quite a lot about how to prepare your company and how to decide as a founder. Let's try to take the perspective of the founder towards the funds. So what are the again, red lights, orange lights from the founder perspective to the acquirer, right? I mean, at the end, you don't want to sell your company to the fund that is not reliable, or like, or I don't know, will just destroy your company. I mean, it's not your company anymore, but still, I think some of the people can feel attached. So are there any red, orange lights when you look at the acquirers?
So first of all, I think very often your gut feeling tells you whether it's a good buyer or not. I think, like, you just get a feeling, like, does it take them too much time to like come back with questions, or do they delay calls? Do they promise something? And you can just also check their track record and see, do they have a track record of buying companies? What kind of companies did they buy? How transparent are they in terms of sharing, like, how the process goes, what kind of deals they make, what they have in mind with the business? So it's a lot about doing your own due diligence, basically, on the buyer. See if they have the financial capacity to do such a transaction. See if they did other acquisitions. Ask to speak to those founders to also do the reference checks. And for example, I like my title is head of origination. So basically, I need to go out and find suitable companies. And you could say my job is to try to convince them to sell to us, but I think it will always go wrong if I kind of convince them. So I think they should come to the conclusion themselves that SaaS.group is a good fit, because otherwise it will hurt everyone involved, because they will not be happy with the deal. We will not be happy with the deal. I will have a bad feeling because I basically push them to work with us. And so I really have a very soft approach to business development. I tell them what we do, how our model works. I can connect them to founders that have sold to us, talk to them, get a less biased view, talk to maybe our SaaS founders, and like talk to anyone they want, and just look at everything they want and try to be as transparent as possible. But at the end of the day, they should feel comfortable. And I think that's a big point. You should feel comfortable handing over your business. And some might argue there's like a so-called fuck you number. So if the offer is high enough, you don't care. And that might be true. I mean, if someone buys your company for a 20x multiple, then you're like, okay, they can do with the business whatever they want. They can throw out the people, they can sunset it. Like, I really don't care. But if you want to have a good new home for your team, for your brand, whatever, make sure that this is the case.
So when I was a part, like at some point of my career, I was the part of integration management office. I was like leading post acquisition process to make sure we find the synergies, etc. And I remember that announcing that the founder of the company was leaving at some point was such a big risk for us, because like he really wanted to find a home for his team, for the brand, etc. And so he was so tight to the company, and people were looking after him basically. And it was like one of I remember like one of the big points of the checklist, when to do it, how to make sure that we sustain the people, because it was an agency business at that time. So like it's not like it was there, technology was there as well, but it was mostly people who are behind who are behind the business. So I think this is like gut feeling perspective, but also on the very human level, right? Do we get along with each other, right? There is like I guess there might be a study on this, that there is a correlation between the success and getting along.
It's a bit like dating, right? You're getting on the first date, like, do you have a good feeling? Do you want to go on a second one? Yes. Okay. What do you want to find out in the second one? And then at some point you might end up in a relationship, but it's not that you have a bad feeling in the first date and you end up in a relationship. That's not going to happen. So you should take the same approach for finding good new home for your business. And yeah, there are multiple things, and just try to keep, like, if you think it's a good fit, try to be committed as well. So don't let them like come to you every now and then and like ask questions, ask for more information. Like, be also proactive to help them build confidence. So it's always two sides. And I mean, such a process can be time consuming from beginning to end. It takes a couple of weeks, depending on the transaction size and the complexity, sometimes months. So be prepared that it can sometimes be exhausting, that they need to see everything and you're constantly distracting from your day to day. But yeah, if it's a good deal and you feel comfortable, it's worth doing it. And I have a lot of founders that have concerns like, oh no, are they really buying such small businesses? Are they concerned about my technical debt? Whatever. Are they concerned about me being mission critical for the business? Like, just bring up those points very quickly and try to get answers to your questions. It shouldn't hold you back from starting conversations in the first place.
Yeah, I think that that also the track record of the acquirer, and how they are on the market. And I don't want to make the now shower of roses toward the SaaS group, not only because I like Dirk, but I like you. But the thing is that I know that, for example, you were investing and we were coaching your startups on pricing, and everyone was invited and they just got a lesson, because like we got along quite well with Anna, and then like, why don't we organize something that they could learn, and beneficial for them, beneficial for you, beneficial for me. Great, right? So and those are small things, but it shows that you care. And I can also second Dirk's work, that he's not really into like selling stuff to the people, but rather telling them how it is. I remember how we've met in like SaaS, and I was like, what you are doing, right? I didn't know you at that time, and then like, this is what we are doing. That's it, right? It was that was it. Okay, Dirk, the last question, and then maybe we can give if there are any other questions from the audience, we can give space to one or two questions. But one question from my side, very tactical: what are your right now acquisition targets? What you are looking for? What would be interesting for you?
Yeah, so we try to aim at least 5 acquisitions every year. Currently looking for mainly product-led companies, self-serve companies, revenue range 1 to 10 million. We run a buy and hold model, so we're never selling those businesses again. That means businesses need to be profitable for us to make sense of an acquisition. And ideally, it's an horizontal product, so it can be used by multiple segments. So far, we've acquired companies in the dev tool space, MarTech space, HR tools, productivity tools, so stuff like that. But even if it doesn't completely fit our criteria, we are sometimes open to deviate from our core strategy. So feel free to reach out. Also, if you're just seeking guidance on M&A topics and how to approach buyers, prepare, and so on. But yeah, horizontal PLG companies, 1 to 10 million profitable. That's
where can we meet you live? What is the next conference that founders can meet you live? Is it Šibenik or you're traveling somewhere earlier?
Yes, it's Šibenik. So SaaS and M&A conference of my friend Leo. Really looking forward to it. We are also organizing a boat trip there, which I'm also looking forward to. And yeah, luckily Leo gave me the chance to come on stage again. So my performance wasn't that bad last year, I guess. Unfortunately, I will miss a few other events, but some of my colleagues like Anna and some colleagues of my M&A team will be at SaaS.group in US. And I think the next one then is SaaS on the Beach. Our founder, SaaS Group founder, Tim Schumacher will be there, I think. Also hold a keynote as far as I know. And yeah, like the typical SaaS conferences, I'm not going to the generic startup conferences, but like SaaS Talk in Dublin, AR Artists in Berlin, and maybe some others I will definitely attend.
Coolio. So we both, I guess, invite you to the Leo's conference called SaaStanak in Šibenik. The weather will be beautiful. The speakers will be great because both me and Dirk are speaking. Jokes.
It's actually more diverse, Chris. You should say that the speaker lineup is more diverse than just the two of us.
Yeah, but it's true. Actually, it's 3 days and multiple speakers, both international and from the region. And then, Dirk, thank you very much for today. I think we had a very nice conversation, friends. If you want to reach out to Dirk, you know where to find him. And to everyone who is listening to us, thank you very much for joining us today, and we see each other most likely in a month from now on the new SaaS topic that we will decipher. So thank you very much and see you soon.
Thank you. And yeah, if you have any remaining questions, feel free to reach out if there's anything we haven't covered. So it was a lot of fun. I hope it was helpful. And yeah, feel free to get in touch.
And follow Dirk on LinkedIn and his newsletter. Big name, by the way. So highly recommend.
Appreciate it, Chris.
Thank you.
Thank you. Bye-bye.